Okay, so let's talk about diversification versus hedging. First of all, what does diversification mean? Well, it's a way of reducing risk by allocating investments among different financial instruments, industries, and other categories. Okay? You're going to put your money in the US, you're going to put your money in China or Asia or Europe, maybe put some money in your bonds. So I'm going to have a bunch of different stuff. What's hedging? Well, hedging is essentially insurance. Although the textbooks define hedging as investment taking out to limit the risk, insurance is an example of worldwide hedging. When trading options, you're hedging. Why? A protective put is an insurance policy. And as everybody in this room knows, we own protective puts. This is a diversified portfolio. If you went to 1,000 financial advisors in Denver, they would all put you in this portfolio. It's a diversified portfolio. Now, I teach this stuff at the university, and I spent my lifetime teaching diversification. What is it based on? It's based on predicting the relationship of assets in the future, predicting the volatility of assets in the future, and predicting the returns of assets in the future. I want you to think about that for a minute. Okay, because I need to know, Jay, who's going to win the Super Bowl, and are the Broncos going to have a good team? Because if you could predict that, we need to go to Vegas together. And if there's anybody in this room that can, it's Jay. But how hard is that, Jay, right? How hard is it to know how good somebody's going to be in the future? Is the S&P going to be up or down next year? Is China going to be the place to be, or is it going to fall apart? So this is almost impossible. How do I predict the weather in the future, never mind the volatility of an asset? And then all I mean by relationship is, if the stock market goes down, is my bond portfolio going to go up, or is my gold going to go up? So that's what we call correlation. And they asked me to teach students this. Well, I tell my students, to say, to build a really good diversified portfolio, you got to predict these inputs. If you don't predict these inputs correctly, you're going to come up with a bad chart. You're going to come up with a bad mix. So how do you predict the future? And I've been doing this 35 years. And here's another problem. When markets get real volatile, and this is the volatility index in the 08 crash, guess what happens to diversification? It falls apart. And I remember Jack and Susan walking in the office, and they gave me their investment portfolio. And I'm not going to mention the name of your advisor firm, but it was with a well-known advising firm. And I looked at Jack and I said, Jack, you're not diversified. And he said to me, yeah, I am. And he held up this chart. He said, look at all the colors. I am diversified. I said, the reason you're not diversified, Jack, is because everything in your portfolio is going in the same direction. And that means that it all tastes like lima beans. There's no diversity on your plate. So what happens is, I don't care if you have bonds, if you have gold, if you have US stocks, if you have international stocks, when markets get real volatile, you can't sell what you want, so you sell what you can, and it makes everything start to trend. It's sort of like being in a forest fire. All the animals are moving in the same direction. This is a Financial Times article saying, diversification only works when you don't need it. Well, okay. They also said, and here they are, the Nobel laureates, they said the best mix is 60% stock and 40% bonds. So that balance is going to give you growth, and then if the market crashes, bonds are going to go up, stocks, that balance. Well, here's a problem. The problem is, why is Dr. Markowitz and Dr. Sharp recommending 40% of your portfolio be in bonds? Well, because diversification, negative correlation, of course, generating income. Vanguard says yes, counterbalancing stocks in a turbulent market, talking about bonds. U.S. News and World Report served as a ballast to counteract the relative normal stocks of volatility. Forbes goes a little deeper. Forbes says there's times when stocks and bonds actually move in the same direction. And bonds are helpful with declines in the market about half the time, but don't offer certainty. Now that's a problem. That's a problem, Keevan. I'll tell you why. Because you say, Dom, here's my life savings, here's my $10 million, and invest it, grow it. I don't want to lose it. Push it along. I want to do better than a CD. So I'm sitting here as a professional, and I'm going to put you in a diversified portfolio, hoping hoping it works. Really? With your life savings, Carol? Hoping? That's not a... So, and not only that, do you realize that there's over $12 trillion of bonds globally that are paying negative returns? Negative returns. Now, Teresa, here's a negative return. You're going to give bank your money and they're guaranteed to give you back less. Guaranteed. The reason being is the price of the bond is more than the interest is paying. So the return they give you at the end of the day is negative. So why would you put 40% of your money in something that's going to guarantee to lose you money? That's the stupidest thing in the world. But that's what's going on right now. And this is Mario Draghi, the head of the ECB. And of course, that's the new Fed Chairman Powell. So Warren Buffett has never been a fan of diversification. He said diversification is what people do when they don't know what they're doing. So let's talk about hedging, because hedging is what we do. So let's talk about Dr. Taleb. Now, Dr. Taleb wrote the book Black Swan, and we talked about the Black Swan at the beginning. He wrote a book called The Black Swan. Now, Dr. Taleb is considered one of the most brilliant minds in the country right now. In fact, if you read some of these reviews, not only has he explained, but he predicted the crash of '08. He predicted it. It goes on to say that the transfer, I can't read that really good, has emerged as a guru of the global financial meltdown. Not only is he riding high in the best-selling book, his theories on black swan events have become basically a recipe for all investors. So the bottom line is that you've got review after review saying this is the person you should listen to when you invest. Well, let's see what he was on Bloomberg a couple of weeks ago. So let's see what he's got to say.
So people have drawn parallels between what's happening in financial markets today, the amount of risk-taking, the nature of the risk-taking, the reach for yield, the flood of foreign capital into particularly U.S. financial assets, drawing a parallel between that and what happened before the financial crisis.
Yes.
Now, the conditions look very similar.
Well, we have a lot of debt, but debt has shifted from private to public.
Yes.
Which is worse, because public debt doesn't go away. Private debt, you can always turn it into equity or punish the people.
You can restructure.
Yeah, exactly. Private debt is generated not by people who are responsible for the debt, but by
there is more public debt,
servants.
but there's still an awful lot of debt on corporate balance sheets today.
They are.
And a growing amount.
Growing, but I'm worried about public debt. My idea is I'd rather be very poor at the timing and good at the hedging. All right. So you want to
that's
be
your business.
Yeah, that's my business. But that's also my philosophy in life. Okay. You don't want to try to depend on specific predictions of catalysts for that crisis. It can happen in an hour, or it may take years. All right. But definitely, we are in a precarious situation. I don't know when that malfunctioning plane will crash, but it will eventually crash. So you need some kind of protection from tail hedging that is done intelligently, not like foolishly, or stay out of the financial markets, which is what we recommend people.
Now, okay, so we're actually getting down to the advice part of the conversation.
Yes.
So if you're a professional investor and you want to take risk, you want exposure, you believe that one needs to have tail risk protection. In other words, catastrophe insurance.
If you know how to do it. If you don't know how to do it, stay out of it.
Or buy it. You can buy it.
You can. It's not easy, because a lot of people think they deliver it and they run out of money quickly or something.
Okay.
It is a very delicate situation. I recommend that individuals stay out of the market.
Pencils down.
Pencils down, unless you know how to hedge. All right. And
few people do.
And few people do. Because,
so at this stage of the game, you would recommend that people have no exposure to financial assets?
Listen, you're not obligated to have exposure to financial assets.
Of course not.
It's not prudent.
Well, people want to save for retirement.
I understand, but you want to save for retirement. That's not prudent, because you got to look at both sides of the story. You may end up with no money.
What's the prudent allocation then? If you're trying to save for retirement, cash?
What I'm saying is that I engage in financial markets if and only if I have tail hedge protection, and it's done right. Otherwise, don't engage in financial markets.
Even in treasury bonds or bills?
No, especially treasury bonds. interest rates, the upside from interest, from holding a bond, the upside is limited and the downside is.
So at what point in the investment cycle does it make sense for individuals to hold financial assets?
To hold, I would say I'd rather have very low return or close to no return than have a huge negative return.
Well, sure, catastrophic loss. Nobody can recover from catastrophic
so a lot
loss.
of people wished in 2007 and 2008, early 2008, a lot of people wished they had no investments.
What about these poor public pension funds with defined benefits that have to generate, actuarially a 7 or 8% return every year?
Tail risk hedging is necessary for these people, so they don't. Because the problem is, if you have a crisis, then you have to generate much higher return later. So you need to be able to have a higher exposure to risky assets, coupled with more tail risk protection.
So in other words, you need to be able to generate something in the double digits to survive.
In other words, if you have the point that we've looked at markets, what tends to happen is that markets go up and then crash.
And then they crash.
You want, but net they're good, okay? But to be able to sustain a crash,
to live through the cycle,
you could probably take more risk if you have the right protection or the right hedging.
As opposed to being conservative and just trying to generate a consistent 6 or 7 or 8%.
Conservative in the middle doesn't work well. You should have a portion of your portfolio in higher risk, but then have good protection against that high risk done properly. It's not. A lot of people think they can call a broker, buy puts, and it's done. It's much harder than that.
Okay, interesting. Most people think they can call their broker and buy puts, and it's much harder than that. And it really is, because we buy puts, and it's not easy. So anyway, here's what you've got. This chart shows diversification, and the X's show what happens when markets crash. Is that all these assets that create diversification, they all start going towards the same risk as the market. That's where all these X's go up. So notice what stays totally inverse correlated is these hedges or these insurance policies. And notice the one that's actually the best. So all this means is if the market's up, this insurance is not going to be needed. But if the market is down, this insurance is going to offset it. And it's pretty much guaranteed. I mean, diversification doesn't guarantee safety. So the bottom line is that why don't more people use insurance in the portfolio? I don't know. I think there's probably a handful of advisors in the country that use hedging. Would you not agree, Madi? And there's 25,000 mutual funds. Well, it's hard, number one. And the real reason is it's too costly. That's why. Now, an insurance policy, protected puts just a straight insurance policy. It defines tomorrow's risk today. Is that right, Kirk?
Yes, sir.
Okay. True genius is applying imagination to knowledge, another one of my favorite quotes. And so before I turn it over to Madi, I recently went to a conference in Las Vegas, and they asked me to speak. And this conference was not for financial advisors. It was for people that work in the quantitative industry. Goldman Sachs, JP Morgan, the big banks, and a lot of brilliant people. So I was honored to speak, and they actually put me on TV. Let's see what I have to say.
Welcome back to NASDAQ Trade Talks. I'm your host, Jill Malandrino, global markets reporter at NASDAQ. We're coming to you live from Vegas at the Global EQ Derivatives Conference. Joining me for this segment, we have Dominic Poloni. He is the CEO of IPS Strategic Capital. We're going to take a look at long vol strategies. Dominic, it's great to see you again.
Yes, Jill.
And I'm excited for this conversation because short vol has kind of been the trend, which works till it doesn't work anymore, as we have seen. So let's learn more about what you're doing at IPS with long vol.
Well, we have 3 products at IPS. What's interesting about bear strategies is if you think about some of the big bear mutual funds, Hoosman, the Prudent Bear, they have a very, very negative carry in a market. The market could be up 10, they might be down 10. They're using essentially a short future strategy. Most other people hedge, they use essentially maybe some type of a 60-40 stock bond mix. They're using debt. Hopefully that debt will go up when the market goes down. They're hoping that the covariances hold. We as an option house, we don't. We actually use a protective put strategy. And a lot of people say you can't use protective puts as an effective hedge. The carry's too expensive. It might cost you 8 to 10, 12% to protect a portfolio over a 12-month period, and that would be too much. The market's flat, you're down 10, the market's up 10, you're flat. So how can you use something that was really designed as a defined hedge, but you can use it in a way that can reduce the cost of holding that? Well, I'd like to say I think we figured that out, Reggie.
All right, so how is that different from traditional put strategies that you were discussing
Okay,
before?
well, first of all, number one, the beauty of optionality is that convexity, that curvature. It's not a linear asset. It's not a future. It's not short the market. I'm not timing and saying, okay, I'm gonna short a basket of stocks. So we're not always delta one on the downside. We don't want to be. So what we can do is we can defray the cost by selling short term to finance a lot of optionality downturn. I learned when I was just learning options, the price of an option roughly equals the square root of time. So that means that if I sell a 9-day option, it might cost me $3. Or I buy a 9-day option, it might cost me $3. If I buy a 144-day option, it costs me $12. So on a relative basis, long-term options are cheap, short-term options are expensive.
Right.
So what that means is I can actually finance a basket of long-dated options, protecting that tail. And our goal is not to protect the first 5% drawdown. It'd be too expensive.
Right.
You don't want to do that. And even a 60-40 mix has about a 50% drawdown against the S&P. But the problem is on a 60-40 mix, you're getting about 40 to 45% of the upside. Not very efficient, negatively skewed. With our strategy, we feel we can capture 60, 70%, fantastically outperform a 60-40 on the upside and hedge much better on the downside.
Right.
And so yes, we can do that. We can use long optionality as what it was designed to do, as a hedging tool. So it's very exciting.
All right, now to wrap up here, 30 seconds, do you think that we're going to continue to see the volatility maybe a little bit more busy than it was last summer for sure?
Well, let me put it this way. They asked at the conference how many people think we're going to see a recession in the next year, a downturn. Only one person raised their hand. That tells me it's coming. That tells me everybody's short vol. This whole conference is about volatility risk premium. Guess what? If everybody's on that side, I want to be on the other side.
All right, Dominic, great to see you again. Thanks for
you.
joining us at EQD. And thanks for joining me throughout the day on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.
Thank you. Nice to meet you, everyone. My name is Madi. My background, as Dom explained, is mechanical engineering. I got my master's in finance and I interned at IPS. I had different plans in mind. I wanted to go get my PhD. I had applied to some schools. I had some interviews queued up for my PhD program. But when I interned with Dom, I noticed that they are doing something very unique in the industry. And they have a very unique perspective. You might have heard him say, always invested, always protected. But if you go in the industry, you'll notice that's very unique. People usually don't hold the hedge all the time because it's too costly. But him and his firm was looking for a way to pay for that insurance policy and hold it throughout the year, every day in a year. I mean, we'll come to that. The other thing is that Dom is a very data-driven person, and I, as an engineer and a person who wanted to go to research and do data analysis, understand the value of that. I can go to his office, talk to him about numbers and data, and convince him to change things in a strategy if I can back it up with the data. We are going to talk about the biases of managers. Overconfidence is one of them. So these are the reasons that I started working at IPS. I want to talk about something interesting in nature, in evolution actually, which is called the attention filter. And this little cute puppy is showing exactly what happens when you try to call your puppy or your dog when they're sniffing on something. You know, it's very hard to grab their attention by calling their name. The reason for that is exactly the attention filter in nature, meaning that a dog gathers information through smelling sense, through olfactory sense. And when they're gathering information through that sense, they block all the other senses. The exact same thing happens in human. So as you can see here, every 1/7 of a second, we take in about equivalent of 300 copies of War and Peace novel. but we only filter it down to a 20-page article. That's about 0.5% of the data we get. That's the attention filter in human. Why does that happen? Because of our brain capacity of processing data. We can only process 120 bits per second. What that means in simple English is when someone is talking to you and you're listening to them, that requires 60 bits per second of processing power. So 120 bits per second means if you close your eyes, shut all the other functions that you do consciously, and listen to two people talking to you at the same time. That's it. That's human brain's power of processing data. So we need to filter the data. We cannot process all the data we get. I want to show you our traders room. Welcome to Patrick's office. This is our traders. 4 different screens, Bloomberg News all the time, and these screens always change. It's not like some windows are hidden. He has to pull out all the information, all the analysis. So is that even possible to process all these data? No. The data filtration happens in every trading room as well. And it happens when Patrick is communicating to Dominic, Dominic is communicating to Patrick about the strategy. The filtration happens based on your mood, based on your background, based on so many things, which is mostly random. Is that the only problem that happens when you want to trade and you manage a portfolio? Of course not. There's another thing that we call it cognitive and behavioral biases. These are just a few of them. There's a lot more. These are just the most important one. Anchoring, which you just hear in the news that the Apple stock is going to go up to 300, and you just anchor your brain based on that, and you don't get out of it until it gets to 300, and you stay on it. But that 300 is based on nothing. It's just because it's a round number, our brain just wants to clinch on that, something like that. That's what we call anchoring. Framing, when you frame the same problem, the same exact information in 2 different wording, decision change, overconfidence, which is very common in all the money managers. They always think they're right. You can never convince that they're wrong. Herding, we always tend to follow everyone else. If everyone else is selling, you're going to sell. If everyone else is buying, you're going to buy. Overreaction, loss aversion, all these biases adds up and makes us make wrong decisions at times. I want to introduce another problem, which is decision making under stress. This is the market on February 5th of 2018. If you remember that day, the market was down 5% in one day, and almost all of it happened in a matter of 2 hours, from about a little bit before noon until 1 o'clock Denver time. The market was down 5-6%. It bounced a little bit back. This is, if you're sitting in a trading room and looking at that chart going down and down and down, and looking at the money that you're losing, accumulating, that's a very stressful situation. And it's been proven that stress can override your logical brain. So there's no doubt in that stress, when you're under stress, you make wrong decisions. Now we get to the quantitative analysis. Now that I talked about all those problems with decision-making process, we come to the quantitative analysis. Quantitative analysis involves technique by which researchers convert data to numerical forms and subject them to statistical analysis. So first of all, we convert all the data. We use big data, databases. We gather data from all the platforms, and we convert them into numerical and mathematical inputs. And using coding, we analyze those data statistically. So there is no emotion involved in that. There is no cognitive biases involved in that. The second thing, which is very important, is that it's coming up with a rule-based strategy, meaning that for every move in the market, for every market situation, for every possible situation in the market, which might have never happened before, but it's possible that it might happen, we are going to have a rule book with a quantitative analysis, and we know exactly what we are going to do, so that decision making under stress is going to be eliminated because we know exactly what we are going to do. We have a rule book. We go just look at it. Okay, the market is in this situation. Volatility is this much. Yield curve is inverting. Vol surface is like that, and we make our decision based on those data. Now, the firm has already had a rule book when I started working for them, and they were doing quantitative analysis. It was just very labor intense. I helped them with computer programming and machine learning techniques to automate so many of those tasks and not be as labor intense. And then when I started working for Dom, he sat with me and he went over the rules and he said, listen, I've been practicing with these rules for over 30 years. I don't want to change anything. I've used different products. I've used stock, I've used annuities, I've used different products, but I've always had these rules in mind. That's why when 2008 happened, I was not down as much as the market. I'm going to go over these rules. And he asked me to come up with those strategies having these rules in mind that meet all these. This is kind of his roadmap all throughout his career. So he said, we do not want to have hidden tails. What do I mean by hidden tails? So many of the firms these days, they show you performance from 2013, 2014, and they say, look how much I've made since that time. Yeah, they've made a lot of money, but because they are having hidden tails, if something like 2008 comes along, they're not going to do as well because they're selling those tails. Those tails don't happen often, but when they happen, they destroy wealth. So Don said, I don't want to have any hidden tail in my portfolio. I want to be able to sit with my client and say, you're not selling any tails, not upside tail, not downside tail. The other thing he mentioned is that he always wants to be protected against October 19th of 1987. You guys probably remember what happened in 1987, October 19th. We were in the market. The market was down 20% in one day. And people were having heart attack down a trading pit standing up, and they couldn't move them out because it was such a frenzy there. So we know, I'm going to explain that in another slide, that we have simulated the same event, and I'm going to show you what our portfolio is going to do if something like that happens. But basically this means is that this helps us sleep at night. We are sleeping at night being confident that if the market is down tomorrow, 20% tomorrow, we're going to have our best day in the fund, performance-wise. Of course, it's going to be bad for the economy and all, but the fund is going to be up. I'm going to show you how much in a few slides down. The third one, he said, I don't want to have a wealth-destroying event. He always talks about that in the office. Wealth-destroying event, if you were in the market in 2008, 2009, and you were about to retire at that time, and you were following the market went down 60% from the beginning of 2008 to 2009. A loss of 60% for someone who wants to retire is a wealth-destroying event, meaning that you need to stay in the market, you need to keep working for another 5-6 years if the market bounces to be able to recover from that loss. So 10% down is not a wealth-destroying. You can recover from a 10%, 12% down in a few good months. But 60% down, you need 120% comeback to recover just start from where you were a few years before that. Asymmetric beta is something we call the first one. You want to have asymmetric beta with the market. So the power of asymmetry, which we call gamma in the industry, is that if the market is losing money, but you're losing way less than the market, and the market is making money, and you're making less than the market, but more than what you lost, down the road, because the capitalist system works, you're going to be up a lot. And I'm going to show you down the road what it's going to look like if you practice that. Always protected with an insurance policy. He talks about it all the time. We don't diversify. We don't use any of it, Markowitz model or anything. We have insurance policy, which is the put option. And we always have it so that if something comes along, without any further notice, we are going to be protected all the time. And all the challenges actually is how to finance this, how to not go bankrupt holding this insurance all the time, because many people ask. And we want to participate on the upside. He always says that if a client wants to just not make any money, when the market is up, they can go in cash, they don't need a money manager. If you just stay in cash, you're not going to lose money when the market is down, but you're not going to make any money when the market is up 20% in a year like 2017 or 20. For many years, for 3-4 years, some people say the market is going to crash one day. Yeah, it might crash one day, but since 3 years ago, the market has been up 50-60% already. So people who have been sitting in cash for those years, they gave up 50-60% of return. So we talked about these rules, and he always keeps reminding us about these rules, and we come up with strategy. What we did is that we started with 2015-16 year. We optimized for that. Then we looked at 2008-9. This is the first 5 months of 2008, which was the harbinger of volatility. The market started, the red line again is the market. The market starts going down, vol started rising. The market was down about 8-9% by the end of the 5th month. The maximum drawdown was about 12% here. We didn't lose as much when the market, the strategy won't lose as much when the market is going down. But the important thing is that we lose money when the market is down 8%, almost as much as the market here. And trust me, after thousands of hours of research, brainstorming, reading academic papers, looking at all the other firms, all the funds, doing analysis and regression works, if you want to participate on the upside, there's going to be a time that you're going to go down with the market. When the market busts, is this the wealth destroying event we were talking about? It appears to be no. Here comes that wealth destroying event. And this is from May of 2008 to March of 2009. When the market was down, just in that time frame, when the market was down 40-some%, 49, almost 50% actually. And what happens to the portfolio? We go down with the market again up to some point, which is 5-6%. And then we start diverging. And this happens because of that gamma that I talked to you about earlier. That gamma starts to kick in. And then instead of going down with the market, actually when the market keeps going down, we go higher because we have a negative beta with the market at that point in time. And this is what we are trying to achieve. 2018 until June of 2019. And again, it shows the same thing. And then we didn't optimize it for this. We just used the same rules that we used to optimize 15, 16, and 08, 09. As you can see again, the blue line, we lose. When the market starts going down, we lose with the market a little bit. But then, as the market keeps going lower, we start diverging. And then I want to remind you of 24th of December 2018. When the market was down about 2.5%, by the end of the day, we were at the point that I was trading that day because Pat was out of the office. And I was talking to Dom. I was Dom, we are flat beta, meaning that from this point on, if the market keeps going lower, we're actually starting to make money. And on 26, of course, the market bounced 4%, which was the highest bounce in terms of point in the market ever. But we were all ready. We were for another 2008-9 event. So it was not something that we predicted that is going to happen, but our strategy works in a way that it goes that way as things go worse and worse. And the numbers are telling that. Maximum drawdown of the strategy was 7%, when the market from peak to trough dropped 21%. And of course, we had lower risk and higher Sharpe and Sortino again than the market. And then when we put it all together, this is the power of asymmetry I was talking about. When you're not losing as much as the market and you're making almost as good as the market, not exactly as much as the market because that's not your goal. Your goal is always to be protected. And blue line, if you ran the same strategy from the beginning of 2008 to June of 2019, the The red line is the market, and the blue line is the strategy that we optimized for. And as you can see, from here, it takes another 5 years for you, 4 years for you to recover from the loss of 2008. But if you don't lose as much, all the upside is yours from that point, as the market keeps bouncing. And then this is a simulation that we ran for what happens if the market is down 20% in one day? What happens in October 19th of 97 comes back? Or what happens if there's a war all of a sudden? Or something like that. This is how a strategy will perform. And this is because this is scaled out. So here, the horizontal line is the market, and the vertical line is strategy. If the market is down 20%, we're actually going to be up 5.88%. Based on how the risk will react and how volatility will react to that movement. It could be different, but this is the ballpark of what happens if the market is down 20% in one day. And that's the effect of that insurance policy that we hold in our portfolio.